Euro to US dollar is sitting on the knife's edge. 1.1368 is the make or break level for the entire week. The daily chart is screaming bearish. Every single moving average is overhead. Wednesday's FOMC is the fuse. If 1.1368 breaks, we are looking at a freefall toward 1.1325 and then 1.1280. Monday's scalp is a bounce off 1.1370 with a tight 20 pip stop. The swing? Short the relief rally into 1.1450 to 1.1475. Target 1.1280. The euro is down 150 pips from last week's high, and the entire market is staring at one number, 1.1368. That's where we closed on Friday. And here's the thing most people are missing. This isn't just another support level. This is the line that separates a 5-day breakdown from a dead cat bounce that traps the entire retail crowd. This week has one danger zone and one 3 to 5 day opportunity. I'll show you both right now. The Federal Reserve meets Wednesday. The market is pricing in a hold at 3.50% to 3.75%. But the statement? That's where the real fight happens. Half the FOMC members have already penciled in a September hike. The oil rally above $100 is forcing their hand. And the euro? It's trapped beneath the 20, 50, and 100-day moving averages like a fish in a shrinking pond. Stay to the end. I'm giving you 2 Monday scalps and 1 swing trade that can run the next 3 to 5 days. And I'm going to show you exactly why Wednesday's Fed decision is the week's ultimate trapdoor. Here's the structural bias for the next 3 to 5 days. Bearish while we trade below 1.1480. That's the line that changes everything. Let me give you the invalidation level right now. Write this number down because if it breaks this week, the whole monthly structure resets. 1.1480. If we get a daily close above 1.1480, the bearish case is void. Period. Now, where's the herd coming into this week? Let me tell you. Institutional positioning is a mess. Large speculators flipped net short on euro futures for the second straight week. Gross shorts climbed to an 18-month high. And yet, the median Reuters forecast still shows euro to US dollar at 1.16 by September. That's the divergence. That's the opportunity. The retail crowd is selling, but the smart money is waiting for a relief rally to sell into. And that's exactly what we are going to do. Let's read the chart from the top down. On the weekly time frame, price is trading at 1.1368, and here's the brutal reality. We are below the 20-week MA at roughly 1.15, below the 50-week MA, and the 200-week MA sits all the way down at 1.1244. That's a 120 pip cushion before we hit the structural floor. The weekly MACD is showing bearish momentum with the histogram contracting but still negative. This is not a reversal signal. This is consolidation before the next leg down. On screen, weekly chart with Mars highlighted, drop to the daily. This is where the picture gets really clear. Price is below the 5-day MA at 1.1429, the 10-day at 1.1475, the 20-day at 1.1543, the 50-day at 1.1516, and the 100-day at 1.1374. That means every single short-term moving average is overhead acting as resistance. The 200-day at 1.1244. That's the magnet pulling price lower. The daily RSI at 39.7 is oversold but not extreme. The Williams %R at minus 90.25 is screaming oversold, but in a strong downtrend, oversold can stay oversold. The 4-hour trend is strong sell across all timeframes, 60-minute, 4-hour, daily, weekly, monthly. That's rare. When you get alignment like this, you don't fight it. You position for continuation. Here's the key level on the 4-hour, 1.1370. That's the support that's been tested repeatedly since late June. Every time price hits this zone, buyers step in. But here's what most traders will miss until Wednesday. Each bounce is getting weaker. The highs are getting lower. The 4-hour MACD is showing bearish divergence with price making higher lows but momentum making lower lows. That's exhaustion. That's a breakdown waiting to happen. Here's what most traders will miss until Wednesday. The 1.1360 to 1.1480 range that's held since early July is starting to compress. The ATR is only 122 pips. That's tight for euro to US dollar. When volatility compresses like this ahead of a major event, the breakout is violent. And with the ADX at 39.99, the trend is strong enough to sustain a move once it starts. The key supports to watch: S1 at 1.1393, S2 at 1.1367, S3 at 1.1327. That 1.1327 level? That's the June 24th low. If we break that, the next stop is 1.1280, then 1.1260, then 1.12. Resistances: R1 at 1.1473, R2 at 1.1499, R3 at 1.1539. That 1.1499 level used to be support. Now it's resistance. Classic role reversal and the weekly pivot? 1.1433. That's the line that tells you who's in control each day. Trade above it. Bulls have a chance. Trade below it. Bears are driving. Now let's connect the dots between the chart and the news, because this week is all about the calendar. The fundamental picture is simple. Oil above $100 is forcing the Fed's hand. The futures market is pricing in 2 rounds of tightening in 2026, with the first expected in September or October. Fed Chair Kevin Warsh has eliminated forward guidance. He wants to maintain an uncertainty premium. That means every statement, every press conference, is a potential volatility event. The ECB? They held rates on July 23rd. Deposit rate at 2.25%. They kept the door open for a September hike, but Lagarde made it clear they're waiting for data. The policy divergence is widening. The Fed is forced to act on oil. The ECB is waiting for inflation to confirm. That's dollar positive. Here's the week's calendar. And this is where the narrative web gets interesting. Monday, July 27th, no major data. That means technical flows dominate. This is where our scalps live. Wednesday, July 29th, 8 p.m. Eastern Standard Time. Federal Reserve interest rate decision and press conference. This is the week's fuse. The hold is priced in, but the statement language is the unknown. If Warsh signals a September hike, the dollar rips higher. Thursday, July 30th, 2:30 p.m. Eastern Standard Time. US Q2 GDP expected at 1.9% YoY, plus core PCE inflation expected at 0.2% MOM, 3.2% YoY. 2 high-impact releases on the same day. That's a volatility doubleheader. Friday, July 31st. Eurozone CPI expected to tick up from 2.8% to 2.9%. If inflation ticks higher in Europe, the euro could get a temporary bid. But don't hold your breath. The dollar story is the dominant narrative. The 1 to 2 week directional lean is clear. Sell rallies into 1.1450 to 1.1475. The dollar remains structurally bid on Fed tightening expectations, geopolitical risk, and the energy shock. What invalidates this view? A daily close above 1.1480. If that happens, the bearish structure fails, and we are looking at a retest of 1.1550 and potentially 1.16. Do you think the dollar closes above 105 this Friday? Comment yes or no. I'm tracking consensus for the week. Most people skip the planning phase. That's exactly where this week's money is made. Keep watching. I'm giving you 3 setups. 2 for Monday's session and 1 swing trade designed to capture the core move of the entire week. Strategy 1. The Monday opening scalp. Here's the first scalp. Monday has no major data, so we are trading technical levels and session flow. The London Open is where the real volume hits. The trigger. If price retests 1.1370 during the London session and holds a 5-minute bullish rejection, I'm looking for long scalp. The logic is simple. This level has been defended multiple times since June 24th. The stop hunters will try to push below it, but if the 5-minute candle closes above 1.1370 with a bullish wick, that's your entry. 1.1375 on a 5-minute bullish reclaim of the 1.1370 support zone. Stop loss 1.1355, that's 20 pips below. Tight. Disciplined, take profit 1. 1.1410, that's a 35 pip move, roughly 1.75 a take profit 2. 1.1433, the weekly pivot. If momentum is strong, we can run it to the pivot risk reward. 1:1.75R on TP1, 1:2.9R on TP2. What instantly voids this trade? A 5-minute candle that closes below 1.1360. That tells us the support has been breached and the sellers are in control. Strategy 2. The Monday liquidity grab, this one's for the aggressive traders. The liquidity grab plays on the stop hunt that typically happens in the first hour of the Asian session or the London Open. Here's the setup. The stop-loss orders from the last 2 weeks of consolidation are piled up just below 1.1360 and just above 1.1480. The algos know this. They're going to hunt one side before the real move starts. The trigger, a fake breakout below 1.1360, price spikes down, takes out the stops, then snaps back above 1.1365 on a 5-minute bullish engulfing candle. That's your entry. You're buying the snapback entry. 1.1365 on bullish engulfing confirmation after a false break below 1.1360 stop loss. 1.1345, just below the spike low. If price continues down, you're wrong. Get out. Take profit 1. 1.1400, the psychological level and the first liquidity pull above. Take profit 2. 1.1420, the 50% retracement of the Friday sell-off risk reward. 1:1.75R on TP1, 1:2.75R on TP2. Warning, this requires aggressive execution. You need to be watching the 5-minute chart with a VWAP overlay. If the spike doesn't snap back within 2 candles, the trade is invalid. Are you scalping Monday or swinging the week? Comment scalp or swing. Let's see who's built for this market. Strategy 3. 3 to 5 day swing, this is the big one. This is the trade that can run from Monday all the way to Friday's close. The weekly and daily structure is bearish. We are below every major moving average. The weekly MACD is bearish. The daily RSI is trending lower. The fundamental backdrop favors the dollar. The only question is, where do we enter? The swing entry is simple. Wait for a corrective daily relief rally into the 1.1450 to 1.1475 resistance zone. That's the optimal swing short entry area. This is where the 10-day MA sits, where the failed bullish confirmation from last week lives, and where the sellers are waiting to reload. Entry 1.1450 to 1.1475 on a daily or 4-hour rejection. I want to see a bearish pin bar or an engulfing candle at this level. Stop loss 1.1550, above the major supply zone. This gives the trade room to breathe. If price closes above 1.1550 on the daily, the bearish structure is broken. Take profit 1. 1.1280, the primary multi-day extension target. This is the June 24th low extension level. Take profit 2. 1.1080, the runner exposure target. This is the macro support that comes into play if the Fed delivers a hawkish surprise and the bottom falls out. Risk reward. Approximately 1:3.8R on TP1. Entry at 1.1460, stop at 1.1550 is equal to 90 pips risk. TP1 at 1.1280 is equal to 180 pips reward. TP2 gives roughly 1:5.8 a dot invalidation. A daily close above 1.1480. If that happens, the swing short is void. Please see the on-screen 3 strategies. The Monday opening SCLP entry, 1.1375, 5M bullish reclaim of 1.1370 support, stop loss, 1.1355 take profit 1, 1.1410 take profit 2, 1.1433 risk, reward, 1:1.75R, TP1. 1:2.9R, TP2, invalidation. Void if 5M candle closes below 1.1360. The Monday liquidity GRAB entry, 1.1365, bullish engulfing after false break below 1.1360, stop loss, 1.1345 take profit 1, 1.1400 take profit 2, 1.1420 risk, reward. 1:1.75R, TP1, 1:2.75R, TP2. Invalidation. Void if no snapback within 2 candles of spiky 3 to 5 days. The NG entry. 1.1450 to 1.1475. Daily rejection from resistance. Stop loss. 1.1550 take profit 1. 1.1280 take profit 2. 1.1080 risk. Reward. 1:3.8R, TP1. 1:5.8R, TP2. Invalidation. Void if daily close above 1.1480. Never risk more than 1 to 2% per trade. Holding through Wednesday's FOMC requires tighter sizing. I'd be at half size on the swing until the statement drops. Stops are non-negotiable, especially on the swing. This is how you survive to trade the next big weekly move. Let me summarize what matters this week. The single most critical level to watch for the entire week is 1.1360. If that breaks with conviction, especially after Wednesday's FOMC, the path to 1.1280 and then 1.1080 is wide open. If we hold above 1.1360 and rally through 1.1480, the bearish structure fails, and we are looking at a retest of 1.1550. But here's the thing about this week, it's backloaded. Monday and Tuesday are technical. Wednesday is the fuse. Thursday is the explosion. Friday is the aftermath. My base case? The Fed holds rates but signals a September hike. The dollar strengthens. Euro to US dollar breaks 1.1360 and tests 1.1280 by Friday's close. If that happens, the whole monthly trend accelerates lowered. If this level breaks on Friday, the whole monthly trend flips. I'll have the updated blueprint for you this Sunday. If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis and then loop back to today's Nasdaq gamma flip later. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that define your week.